But does it impress Jignanshu Gor or not? Let's ask him exactly that. Jignanshu, hi, morning. Great to be speaking with you as always. Your take on Eternal, how are you digesting those earnings?
Good morning, and thank you for having me. It's always a pleasure. Very strong sets of results, right? I would say exceptional results under very difficult circumstances in terms of competitive intensity. We do have written in the past and believe that the competitive intensity is at its peak right now. It's the highest we've ever seen. And to grow almost 19% quarter on quarter, 86% YOY on the quick commerce side, uh, plus expanding margins while doing so, we think it's impressive. Of course, the cost structure keeps oscillating a little bit depending on the priorities of the management, but the ability to deliver margins as the only profitable player in the street, we think it's very impressive.
Jignanshu, hi, Sajid here. Uh, you know, while we've seen a 19% quarter-on-quarter growth for the QC, the net average order value has also marginally declined. Do you see the current scenario of consumption is one of the reasons why that has come down, or is there any other reason?
We think it can be a combination of things. It could be that consumers are choosing lower order value on as they become more and more comfortable on Blinkit as a platform. So rather than ensuring every order is of 600, 700 rupees, people are ready to order 300, 400 rupees as well, which is positive for Blinkit because it adds frequency of consumption. It could also be that out of all the quick commerce players, Blinkit has the highest proportion of non-metro stores. Almost 45% of their stores are outside. And the consumption basket outside non-metro might be smaller than those we see in metro cities. So it could be a combination of either. We don't think it's a major call for concern as of now, as long as the revenue per order can be maintained above the direct cost per order.
Jignanshu, another thing which is there is the kind of discounting that we have seen as a competitive intensity is the highest or is at its peak. You also seeing some kind of high discounting also which is coming in, especially when the third player is trying to come in with an IPO and garner as much market share as possible. How do you look at this entire scenario of discounting? Is that a concern?
See, I think the discounting, we maintain a discounting tracker. It has been high since almost November last year, November of 25 so far. And it's not one player, almost everybody increased their discounts at the end of that period, including Blinkit, followed by all the peers who are in this industry, all six of them. Today, Blinkit is probably has the least discount amongst all players. So to deliver the growth despite not providing the amount of consumer incentives that others are, we think that's the impressive part. That you have a consumer profile and a behavior which is able to support your growth thesis. The discounting, we don't expect it to be like go away immediately, but we do think it's at its peak. Over the next 6 months, this intensity should gradually reduce as the scale up period for most of the new players is achieved. They reach a certain scale where it then the capital allocation question necessarily dictates that you ask how the unit economics are evolving.
Jignanshu, hi, morning. What do you make of the commentary, right? Because I think on the quick side of things, and that's where a bulk of the valuation also comes from now. Excuse me. On the quick side of things, what the management seems to suggest is it's not going to be discounting which is going to drive the economics of it. It's going to be more from a capex perspective and how they're able to manage stores, which is going to drive margins as well as the economics and the moat, all three. I believe that was what the management really said. Talk to us about how you see margins shape up and what you make of that piece of commentary which came out.
I think what the management is hinting at is that unlike food delivery, this is not a truly platform business or an asset-light business. In this business, capex is necessary part of growth, and effectively the rate of growth is restricted by how many stores you have. because there is a natural limit to both what market share you will get in a particular catchment and how much throughput each store can handle. With that in mind, what the management is looking at is how are the stores shaping up. So they're improving their margin guidance is a big positive in our view. It just shows the confidence that the management has, and presumably many of their metro cohort of stores may be running at those kind of margins, right? For the management to have the confidence that irrespective of what might happen on the cost inflation side, we will be able to deliver these margins. So that store addition remains an important part. The second part, Harsh, I think, is increasing frequency by assortment. And Blinkit again has so far led the industry in increasing the range of assortment, going deeper into grocery and going wider outside of non-grocery, which adds AOVs but also adds to the frequency of consumption for consumers and makes it decidedly different from e-commerce, that you have a core grocery purchase basket, and then you also offer a lot of non-core items. So those two vectors, I think, differentiate it, and hence possibly the confidence. Clearly, the commentary is extremely bullish given the amount of investment that we are seeing from peers. And I think backed by performance is what makes probably the management the right to be that bullish.
And Jignanshu, this commentary, does it propel you to change your targets whatsoever?
We think we looked at it very closely. We think that current margin profile is still pretty thin, and the competition hasn't gone anywhere. So we would say that the chips need to fall a little bit more before we raise our target price. We do believe the industry is super attractive, and Blinkit will be one of the large players in this industry. But a little bit more proof of the pudding or some events on the industry side before we can change our target price.
Jignanshu, how do you look at the foray of Reliance and Amazon into this? Because in the Reliance retail numbers, there has been an aggression with respect to online and e-commerce, which is there. Do you see that playing out in the next few quarters as well?
So Sajid, we don't cover Reliance, so difficult to comment on, particularly on the stock, as well as Amazon being an unlisted player. But what I would say is, see, the competitive intensity has been high for last 12 months. The companies have been adding stores very fast. Both all the unlisted players have been faster than Blinkit, of course. We estimate that in the last 90 days, almost 900 stores were added at an industry level. So the competition has already been very high for a while. I don't think the competition is going to increase from here, either in terms of more stores by players or in terms of more discounting by players.
All right, Jignanshu, thank you so much for joining us this morning, giving us that perspective.
Happy to, always a pleasure, Harsh. Thank you.
Great.